Welcome back, folks. In this short video, I want to teach you how to identify institutional order flow. Okay. Now, in this video, I'm going to be talking about the euro, and I'm going to be indicating where I believe the euro might be headed in terms of its order flow. Now, that is not a trade recommendation. In this video, we're learning about price action and algorithmic principles. Okay. So I want you to monitor the charts and the future price action that I'm going to be discussing. Okay, so we're first looking at the dollar index, okay, which trades inverse, right? Well, I should show the euro trades inverse to the dollar index. Now here we can see a few things that I want to point out. You had accumulation, okay, and what we can see after that accumulation is the manipulation and then the distribution. Okay, so the very classic AMD that ICT talks about. Now we can see that the dollar index found resistance at the volume imbalance. Okay, you've always got to have your volume imbalances marked, especially for the dollar index. It respects these volume imbalance levels very, very well. Okay, now in my view, the draw on liquidity is down much lower to where we are at this point in time to those equal lows. Now this is a monthly chart, so some time will need to pass before we get down there. Okay, but we can see already we have some quite aggressive displacement. Okay, now what I also want you to realize is where there are liquidity pools. Okay, have a look at the chart. And I want you to look at, try and identify prior to the expansions up or down, there are engineered liquidity pools, right? Now, I'm not going to mention them right now, but I'm going to highlight them in our discussion on the euro. So let me open up the chart of the euro. So you can see the euro is a direct opposite view of what we saw on the chart of the dollar index. Okay, so we have the accumulation, right? We have the manipulation, and then the distribution. In my view, the euro is headed first to this minor buy-side liquidity pool, okay, where reside buy stops above from institutions who are short, right, and then this major liquidity pool, right. Now, a couple of things I want to mention is that I want you to look at prior to this manipulation. What did the market do? The market first engineered liquidity in the form of equal lows. Okay, and you'll often see that. And where did the market come into? It came into this discount period array. And you can see a small consolidation prior to the expansion. Okay, now I want you to notice what the market engineered prior to that expansion. Well, the market engineered these equal highs prior to that expansion. Okay, so the market needs to have liquidity on both sides. Okay, now what I want you to look at is how we can identify the change in market structure, right? The change in direction. Well, when we have taken liquidity on the downside, okay, so we've taken sell side with that move down, I want you to notice that we have a SIBI, okay, right there, okay? So that SIBI was formed on the way down to take out liquidity resting below those lows, those equal lows there, okay, sell stops. And the market was reaching for this fair value gap, which is a discount PD array, okay? And we can see for a few months we consolidated prior to that expansion. Now, if we have a SIBI, then that SIBI should offer resistance on the way up, and we should see the market reprice lower, potentially taking out liquidity resting below those lows. However, instead of seeing resistance, we actually see that the market closes in that SIBI, okay? Meaning that it has disrespected that bearish signature, okay? So when the market does that, on the next candle, we can expect expansion higher, and the target would be liquidity resting above, which is essentially these equal highs, okay? Now, from that point onwards, we can see that the market has expanded, and now we have closed above the series of down candles, which becomes our bullish order block on this particular time frame, on this chart. Okay, so that is now our bullish order block, those three sequence of down candles that have taken liquidity, that's important, and have come from a discount period array. So remember, in my videos regarding daily buys, I asked myself two questions. Where has the market come from, and where is the market going? Where has the market come from? It has come from a monthly discount period array. Where is the market going? Well, it's going to the liquidity pool resting above the market. Okay, so at this point in time, I want you to notice a few more things. Okay, so this candle here has expanded up and closed above these sequence of down candles. And so we want to wait for a retracement back into the bullish order block on this monthly time frame, which is what we get in this particular month. Now, at that point in time, my target, if I were to long this market, will simply be back up to this high, right? Because that is the most sensible and the easy target. And that is by no means a small movement, okay? So we're talking about a movement from this bullish order block, okay, in this candle after seeing this month close above the down sequence of candles. And so your entry would be here at the open of the sequence of down candles. And all you would target is the liquidity pool resting above that particular high, because that is the high that you have available when you are entering from that particular month. Okay, and as I said, that is by no means a small movement if we measure from the open of the bullish order block to that high as 400 plus pips. Okay, now I always prefer to long the market at discount, okay, or short the market from a premium. So if I were interested in longing this market, I would not be interested in longing this market from its current level, okay? I would want this to come into some form of discount. Now, what would be discount? Remember, this is not a trade recommendation. We're learning about price action, so I want you to monitor price from this point forward and see if it behaves as I'm anticipating in this video. So I would identify the following levels as discount. Firstly, we can see this wick, okay? Any wick below the market is going to be discount. So we've closed above this wick, and we also have this wick. Okay, so these are two wicks that I would be looking at. I would probably not be interested in this wick and want the market to come into this wick, a deeper discount. These wicks are to be treated as fair value gaps. Okay, so I would draw a midpoint. Okay, if the market can pull back into that level, to me that's discount, right? Or this fair value gap, right? Now, the bottom fair value gap is a fair value gap. I'll just change the style of this so it doesn't look like a volume imbalance. Okay, so this bottom fair value gap is a breakaway gap. Usually the first fair value gap in the immediate expansion is typically left open, and we really don't want to see price retrace back down that low. Okay, to me that would be a concern. So I would prefer the market come back down into this particular fair value gap. That would be discount for me. And notice that it overlaps with the fair value gap on the other side, right, on the left-hand side of the curve, making that a level that I'd be interested in if we came down there. Okay, again, not a trade recommendation. We're learning about price action and how to identify institutional order flow, and I'm teaching you now how to identify discount, okay, from where we can expect repricing higher from. Okay, so I would not be interested in this market anywhere at the current level, even though with high probability I understand that the draw on liquidity is higher, right? So even though we're here, I'm expecting movement above that level, and above that level I am not interested in taking a long position from this because I don't see that as a discount, okay? I would demand the market come minimum down to here, preferably down to there, before I'm at all interested. And all I would do is target the closest high, right? The closest liquidity pool. So for example, if we did come back down to this level and I saw the setup that I needed to see to engage with price from that level, expecting repricing higher, I would simply target this high, okay, from there. I don't demand the best exit, okay, because I don't need to be profitable. And if I just measure from there to that high, that's no small movement, that's 500 pips, okay? Even better, and what I would like to see is the market to pull back into this fair value gap, okay? And then I will simply, as previously mentioned, target that high, because that is an easy target for me, right? And that, just as mentioned previously, from here will be a greater target of 700 pips. I don't have to enter at a discount, whether it's the fair value gap or the discount wick, and then target the all-time best exit. I don't need to do that. I just want to be profitable, and I want to take the easy exit, which would be if the market retraced down, pull back into discount, and I decided to enter that market for reasons that I believe we are going to reprice higher. And I don't just do that automatically. I need to see a setup to engage with price, okay? Then, as I said, I would simply look for that to be my targeted liquidity pool, where I would expect there to be buy stops residing above that level from folks who may be short from that level, for whatever reason, right? They may see, for example, in the coming month, we may see a spike up and then a rejection and then a movement, and where people may engage to the short side, right? Maybe expecting price to come into here, or maybe even expecting price to take out those lows, okay? Everybody has their own view of where the market's going, right? So that means those folks who are short based on some kind of bearish setup, maybe a rejection from the high of this current month, which is June, right? So we might see next month, right, the month rejects high of June and show some kind of bearish signature where people enter short positions. And if they do, their stops are going to be above that level. And that's what I want to target if I were to enter on any pullback to the discount wick or to the fair value gap. I'll be targeting that level right there because I know above that level will be liquidity that allows me to offset any long position that I might enter in from that level or that level. Okay. Ultimately, I would be looking for continuation longs until we get to these two liquidity pools. Again, it's not a trade recommendation. I want you to monitor the price. Okay, this is a monthly time frame, so it'll be a very good lesson for you to drop down into weekly and daily time frames and monitor how this market is moving along its journey to the high time frame objective. Okay, so go back, open this chart, look at the dollar index, look at the euro, and study it week to week, right? Identifying discount PDRAs being respected. That's what we want to see for continuation bullish order flow. Look at how the market takes out its previous daily lows, right, each time to reprice higher. That's what we want to see. Okay, sweep of previous daily lows to continue higher as the weeks evolve until we achieve the monthly higher time frame objective. Okay, and we should see on the dollar index continuation to the downside until we get to its equal lows. Okay, and that means respecting premium PDRAs on the dollar index and on the euro respecting discount PDRAs. Okay, so I hope this video is useful. Go back and study the charts, mark out the discount PDRAs and monitor this market over the next few weeks until we get to the higher time frame objectives. Okay, identify and mark out accumulation. Right, learn how the market first accumulates, manipulates, and then distributes. Okay, and that manipulation always comes into some level of PD, right? Some kind of signature. So if it's manipulating to the downside, it should be coming to a discount PDRA to distribute to the upside, coming up to some liquidity pool above the market or some level of premium PDRA. Okay, hope that video is useful. I will now talk with you in a future video.